Imagine you built something with your neighbors 60 years ago. A club, a powerful globe-shaking club that literally controlled the price of a resource the entire world needed to survive. For decades, it worked. You got rich, your neighbors got rich. The arrangement made sense. But then, one day, you look around the table and realize your neighbors are pumping the brakes on your ambitions. Your production is capped. Your expansion plans are blocked. And while you've spent hundreds of billions building the world's most advanced oil infrastructure, you're being told, slow down. So here's the question. Do you stay loyal to a 60-year institution, or do you walk out? Because in May 2026, the UAE didn't just walk out. They slammed the door on OPEC, and the reverberations are still shaking oil markets around the world.
To understand why this is such a massive deal, we need to go back to September 14, 1960. Baghdad, Iraq. 5 nations, Saudi Arabia, Iraq, Iran, Kuwait, and Venezuela, sat down and formed what would become the most consequential commodity cartel in human history, OPEC. The Organization of the Petroleum Exporting Countries wasn't just an economic alliance, it was a geopolitical weapon, a message to Western oil companies and consuming nations that the producers were in charge now. The UAE joined in 1967, and for decades, Abu Dhabi played the role of the quiet, disciplined member, not the loudest voice in the room, that was always Riyadh, but a reliable partner, a team player. Here's what seemed totally normal. Saudi Arabia functioned as OPEC's de facto leader, setting the tone, managing quotas, and using the collective output to influence global prices. The UAE, as a smaller producer, generally fell in line. But here's the warning sign nobody wanted to talk about. The UAE wasn't staying small. Through ADNOC, the Abu Dhabi National Oil Company, the Emirates spent years quietly executing one of the most aggressive oil infrastructure expansions in history. New fields, new pipelines, new refining capacity. A target of 5 million barrels per day by 2027, up from roughly 4 million today. They were building a sports car engine, and OPEC kept telling them to drive 40 miles an hour. But here's where it gets interesting. Let's talk about what OPEC quotas actually mean in practice, because this is where the frustration was born. When OPEC, plus Russia and other allied producers, sets production targets, each member gets a specific number, a ceiling on how many barrels per day they're allowed to pump. The logic is straightforward. Limit supply, support prices. Everyone earns more per barrel. In theory, beautiful. In practice, a political nightmare. The UAE's current quota inside OPEC Plus sits at roughly 3.2 million barrels per day, but ADNOC's actual production capacity already above 4 million barrels, and by 2027, they're targeting 5 million. Do the math? The UAE has built at a cost of tens of billions of dollars an oil production machine that is 1.8 million barrels per day larger than what OPEC lets them use. That's not a minor inconvenience. That's roughly $180 million in daily foregone revenue at $100 per barrel every single day, sitting idle because of a quota agreement that benefits producers with smaller ambitions. Now here's the kicker. When the UAE repeatedly asked for a quota adjustment, citing their expanded capacity, Saudi Arabia resisted. The negotiations during the 2021 OPEC Plus crisis gave the UAE a partial increase, but never close to what their infrastructure justified. The quiet partner was getting tired of being quiet. Here's something the mainstream financial media consistently underplays. Saudi Arabia and the UAE are not best friends. Yes, they're both Gulf monarchies. Yes, they're both Sunni Arab states. Yes, they cooperated in Yemen. But beneath the surface, these two nations have been locked in a slow-motion rivalry for regional supremacy, economically, diplomatically, and culturally. Think about it this way. Saudi Arabia has Vision 2030, Mohammed bin Salman's grand plan to transform the kingdom into a tourism, tech, and entertainment hub. The UAE has already done most of that. Dubai is a global city. Abu Dhabi hosts the Louvre. The Emirates attract hundreds of billions in foreign investment every year. The student became the teacher, and the teacher didn't love that. Now layer in the oil dynamic. Saudi Arabia's entire fiscal budget depends on oil revenues in a way the UAE's no longer does. Riyadh needs high oil prices to fund its social programs, its mega projects, its Vision 2030 ambitions. So Saudi Arabia has a structural incentive to keep OPEC's production cuts in place and prices elevated. The UAE, their economy is already 70% non-oil. They've diversified into finance, tourism, logistics, real estate, technology. For Abu Dhabi, pumping more oil at slightly lower prices can still generate more total revenue than pumping less oil at higher prices because their cost of extraction at around $5 to $7 per barrel is among the lowest on Earth. Completely different incentive structures sitting at the same table pretending to agree. Plot twist, they stopped pretending.
This is where the story gets really interesting, because the UAE's exit from OPEC wasn't a rage quit. It was the final move in a decade-long strategic chess game. ADNOC, under the leadership of Sultan Al Jaber, the same man who chaired COP28 in Dubai, which itself told you everything about how the UAE plays multiple sides simultaneously, has been on an extraordinary capital investment binge. Since 2016, ADNOC has committed over $150 billion toward expanding its upstream capacity, new offshore fields, unconventional resource development, world-scale LNG expansion at Ruwais, downstream petrochemical integration. The target? 5 million barrels of oil equivalent per day by 2027. To put that in perspective, 5 million barrels per day would make the UAE larger than Iraq, larger than Iran, and not far behind Russia. Here's the strategic logic. The UAE looked at the global energy transition and reached a contrarian conclusion. The window to monetize oil reserves isn't closing slowly, it's closing fast. Electric vehicle adoption is accelerating. European energy policy is shifting. AI data centers are driving electricity demand, but increasingly towards renewables and nuclear. So ADNOC's calculation was cold and rational. Pump as much as possible, as fast as possible, before the window closes. Every barrel left in the ground after 2035 might be worth significantly less. OPEC's production discipline was quite literally costing them the future. Before we continue, if you're starting to see why this was inevitable and not just a geopolitical headline, hit subscribe, because this channel is where we dig past the surface on exactly these kinds of stories.
Here's a phrase you need to write down: strategic autonomy. It's not just a buzzword in Abu Dhabi's policy circles. It has become the organizing principle of UAE foreign and economic policy over the last decade. What does it mean in practice? It means the UAE refuses to be locked into any single alliance system, whether that's OPEC, Western security structures, or Chinese economic dependency, in a way that constrains their freedom of action. You see this pattern everywhere once you know to look for it. The UAE maintained relations with Israel and Iran. They bought F-35s from Washington and negotiated Huawei 5G infrastructure and kept Beijing happy. They participated in Abraham Accords normalization with Israel while refusing to fully break with Moscow over Ukraine. This is a small nation of 10 million people that has decided we will not be anyone's satellite. We will not be told what to do. OPEC, specifically Saudi dominance of OPEC, had become the last major constraint on that autonomy. The one place where Abu Dhabi genuinely had to take orders, or at minimum, negotiate endlessly for permissions that a sovereign nation shouldn't need. When the UAE announced its exit in May 2026, senior Emirati officials used careful diplomatic language, but read between the lines, and the message was unmistakable. We are not a province of Saudi Arabia's oil policy.
Here's what makes the UAE's position unique in a way that, say, Nigeria or Angola simply cannot replicate. They can actually afford to blow up their relationship with OPEC. Look at the numbers. UAE GDP in 2025 crossed $530 billion. Oil and gas now contribute roughly 30% of that, down from over 80% 2 decades ago. The other 70%? Finance, tourism, re-exports, real estate, technology. The Abu Dhabi Investment Authority manages an estimated $1 trillion in assets globally. Dubai's non-oil trade hit $780 billion in 2024. Let that sink in. A city that didn't exist as a global metropolis 40 years ago is now running nearly $800 billion in annual trade, almost none of it oil. The UAE has built something no other OPEC member has successfully built at scale, a post-oil economy that actually functions, which means oil is now an asset to optimize, not a lifeline to protect at any cost. Compare that to Saudi Arabia, where oil revenues still fund roughly 60–70% of government expenditure, or Venezuela, where the entire economy is functionally held together by crude exports and hope. These nations need OPEC's price discipline. They have no choice. The UAE had a choice, and in May 2026, they made it. This is where it gets crazy, so stay with me.
When the announcement dropped in May 2026, Brent crude fell $4.70 in a single session. That might not sound dramatic until you realize that represents roughly $470 million in daily revenue evaporation for Saudi Arabia alone in one day. Traders immediately began pricing in the scenario where UAE production scales aggressively toward that 5 million barrel target. Simple supply-demand math. If 1.8 million additional barrels per day enter the market without corresponding demand growth, prices face structural downward pressure. But here's the bull case versus the bear case. The bull case, OPEC Plus holds together without the UAE. Saudi Arabia, Russia, Iraq, and others maintain discipline. The cartel proves it doesn't need Abu Dhabi to manage prices. And frankly, global demand, driven by India, Southeast Asia, and Africa, absorbs the additional UAE supply comfortably. The bear case, UAE's exit triggers a credibility crisis. Other members, particularly Iraq, Kazakhstan, and Nigeria, who have also consistently cheated on quotas, use this as cover to pump freely. The cartel fractures. You get a 2014-style price war. Brent crashes towards $60, and petrostates from Riyadh to Caracas face fiscal catastrophe. History, by the way, suggests the bear case has teeth. The last time OPEC faced an existential credibility crisis, in 2014 when Saudi Arabia flooded the market rather than cut a loan, oil went from 110 to 28 in 18 months. We'll get to what that means for today's markets in a moment.
Saudi Arabia's response to the UAE exit has been publicly measured. Crown Prince Mohammed bin Salman's team issued diplomatic statements emphasizing the importance of continued cooperation and bilateral ties. Privately, this is Riyadh's worst nightmare. Not because the UAE leaving hurts OPEC's production numbers immediately. The UAE was already the most unreliable quota-compliant member anyway, but because of what it signals. If the UAE, the Gulf's most sophisticated, diversified, globally integrated economy, publicly decided that OPEC membership wasn't worth the constraints, that's a permission slip for every other ambitious producer to reconsider their commitment. Iraq, producing around 4.3 million barrels per day, has its own quota frustrations and its own ambitions. Libya, emerging from years of civil conflict, is rebuilding capacity. Even Nigeria, despite its infrastructure challenges, has new leadership pushing aggressive production targets. The UAE just handed all of them an argument. And here's the deeper Saudi nightmare. If oil prices fall significantly due to oversupply, Vision 2030's timeline and the social stability it's designed to maintain comes under enormous pressure. MBS needs roughly $70–80 oil to balance the Saudi budget. Below that, the kingdom either draws down reserves or makes painful cuts. The UAE, with its diversified revenue base and trillion-dollar sovereign wealth fund, can weather $50 oil. Saudi Arabia cannot, not easily.
The actual breaking point didn't happen in May 2026. It happened quietly over years in a series of closed-door OPEC Plus negotiations where UAE delegates kept asking the same question and kept receiving the same unsatisfying answer. The question: can our baseline quota reflect our actual production capacity? The answer, shaped by Saudi insistence on cartel discipline: not in any meaningful way. The final straw, according to sources cited by major energy analysts, was the OPEC Plus December 2025 meeting, where the group extended production cuts into mid-2026 again, the fourth consecutive extension, while explicitly declining to revisit individual country baselines until 2027 at the earliest. That was the moment Abu Dhabi's patience ran out.
Within weeks, senior Emirati officials began quiet diplomatic consultations with key energy consumers: India, China, South Korea, Japan. All of them, not coincidentally, would benefit from UAE production increases and the lower prices that might follow. By April 2026, the decision was made internally. The formal notification to OPEC came in early May. Who won? ADNOC's shareholders, including 24% public float listed since 2022, saw the stock surge 8% on the announcement. Foreign investors who had bet on UAE energy expansion cheered. Asian refiners who depend on Gulf crude began renegotiating long-term supply contracts with ADNOC directly, at prices no longer constrained by cartel minimums. Who lost? Saudi Aramco dropped 3.2% the day of the announcement. Russian energy majors sold off. Every petrostate whose fiscal model depends on disciplined OPEC pricing suddenly became a little more vulnerable.
Now, before you sit back and file this under just another oil story, let me give you the bigger picture, because this is the canary in the coal mine for something much larger. We're watching the slow-motion disaggregation of the post-1970s commodity order. OPEC was built on a specific premise that producer solidarity could overcome the market-clearing power of Western consumers and multinational oil companies. For 60 years, that premise held. Imperfectly, chaotically, but held. The UAE's exit tells us that premise is breaking down, not because of Western pressure, not because of the energy transition, but because the producers themselves no longer share the same interests. Here's where similar patterns are emerging. Look at OPEC's African members, Nigeria, Gabon, Congo, who formally left or reduced engagement in 2023. Look at Ecuador, which quit in 2020. Look at Qatar, which exited in 2019 to focus on LNG. The cartel is shrinking, and each exit makes the remaining members' commitment less credible, which makes the next exit easier to justify. Which countries face the sharpest fiscal crisis if prices collapse? Iraq, whose entire state budget runs on oil. Angola, with limited reserves and declining production. Venezuela, which barely functions at current prices. This is a system that is fracturing in slow motion, and the UAE just accelerated the timeline.
3 things this story teaches us, and don't skip this part because it actually matters. Infrastructure investment creates irreversible strategic pressure. The moment ADNOC broke ground on that $150 billion expansion, the UAE's exit from OPEC became mathematically likely. You can't build capacity you're not allowed to use. Eventually, the economics demand you change the rules. Diversification is leverage. Every other OPEC member stays because they have to. The UAE left because they could. The most powerful geopolitical word in the 21st century isn't military or nuclear. It's optional. Build enough alternatives that every alliance becomes a choice, not a necessity. Cartels work until the members' interests diverge. That's not cynicism, it's game theory. When costs and benefits align, cooperation holds. When they don't, no amount of institutional history prevents defection. The UAE just proved that 60 years of membership means nothing when the spreadsheet says leave.
Here's the question I'll leave you with, and I genuinely don't know the answer. If the UAE's model works, if they pump freely, prices stay manageable, their economy thrives, what's Saudi Arabia's argument for staying in OPEC? What's the compelling case for quota discipline when your most sophisticated neighbor just demonstrated you don't need it? Because if Riyadh starts asking that question seriously, we won't be talking about one country leaving OPEC. We'll be talking about its obituary. If this breakdown gave you something to think about, subscribe. This is the kind of story this channel exists to tell. And drop a comment. Do you think OPEC survives the next 5 years? Or is this the beginning of the end? I read every response. Next week, we're looking at something equally explosive. How the global AI investment bubble is starting to crack, and which economies are most exposed when it does. Stay curious, stay skeptical, and never trust the headline.